Hello there and welcome back to Dukascopy TV. I'm Monica Gibson and I'm joined in the studio by Ron William. We're going to be talking about macro cycles and breakouts from all things in the S&P 500, Eurodollar, crude oil and gold. Ron, thank you very much for coming in today.
Thank you, it's a pleasure to be here. Happy Thursday.
Happy Thursday to you too. Now, if we first of all draw our attention to crude oil, they fluctuated quite a lot before Ben Bernanke's testament or the FOMC meeting minutes. Now, we've got a lot of things on our cards here. We think that tapering off is soon going to be of QE is soon going to happen, perhaps by the end of the year, and obviously geopolitical concerns across the world. So if we look at crude, tell us a little bit about where you think the main key cycle timing may be here.
Well, sure. As you might remember, Monica, the last time we spoke about oil, we were talking about this breakout, this price and time breakout, which occurred around the June 28th cycle, plus or minus a few days. And now we've seen roughly a 6% move to the upside, which is a very fast move so far. The next target should be the 2012 peak levels, March peak, around $110. I've just highlighted there on the chart. But we still need to confirm above $106 in order to then sustain that move higher. But the big story here is a $10 plus move on West Texas and potentially Brent crude as well. So it's still a lot more upside to come.
Okay, now next in line, if we talk about the S&P 500, what would you say are the key trigger levels here that we should be looking out for?
Well, key trigger levels are basically the all-time high at 1687, which we're just literally just shying away from at the moment. And beneath on the low side is 1600. That's psychological, but it's a psychological pivot level within the market. What's important here is the macro cycle that we spoke about some time ago on oil is now another cycle is showing up for some of the other key markets, S&P 500, gold, potentially oil, and gold, for example. So this is a time window which started to the 18th of July into early next week. So it's just a time where we might see some volatility potentially based on just probabilistic studies. And at the moment, the S&P 500, it would be key to watch out for those levels. Now,
gold is something that you brought as an example there. One of the interesting things with gold's performance, given that 30% drop, if we look at the chart, is that its performance is quite similar if we hark back to 2008. Therefore, what kind of warning bells should we be keeping an eye out for here?
All the warning bells that it might suggest, in the sense that gold is seen as a general hedge against economic or political instability, but in occasions when there's a lot of deleveraging in the markets, and maybe traders and investors needing to deleverage certain trades in order so they can pay off other trades, you'll see gold get hit quite strongly, especially when it's had a strong run into a psychological level. Previously, it was almost at $2,000. And in 2008, it was almost at $1,000. It was these key technical junctures. But what's interesting is that the alarm bells, the warning signs that you mentioned, have already been triggered early this year. We've already had a 30% correction in gold. But what I'm looking at the moment is that we're approaching this target zone between 1120 and 1000, that big psychological level 1000, which is actually, as I just mentioned, the levels from 2008. So it's a big psychological level for that reason, could provide an important exhaustion zone for gold and a potential buying opportunity. So the two quick messages here is, one, it suggests that there is still more tail risk, in my opinion, to come. My cycle studies are suggesting that the next few weeks into early next year. And two, that most of the gold move may be already done on the downside, and this may be a potential buying opportunity coming afresh. So the
potential risk and obviously opportunity that goes alongside it there. But with the volatility that you spoke about, if we talk about the Eurodollar, now the Eurodollar was obviously highly looked at after Bernanke's testament as well. But interesting thing, it has been sort of range bound for some time. So what are you thinking looking forward for this currency pair, would you say, Ron?
Well, it's not so clear at the moment because it's been within this range, this long-term range, for some time. It has deviated above and below that range, of course, but pretty much within the range. At the moment, the key levels are 130 to 207, which we're pretty much trading at the moment, and then above that 134.16, which is the previous high. My preference scenario, so that's one scenario on the upside, but my preference scenario is on the downside, where we get a clear break beneath 127.55. That's a key level, and you can see that the yellow dots I've just marked on the chart just showing you the key inflection points, which really reinforces that level. If we do break beneath that level, which I believe we might, then the initial target is way down into 123. Now the key thing to highlight here is this would be euro negative and potential euro risks happening within the region over the next few weeks and months, we'll find out. But more specifically, this would be US dollar positive. And this is something that we can see on the US dollar index chart, and we can also see at most currencies versus the US. The US dollar is starting to outperform most major currencies. And I think that story will start to play out more, especially if we start to see increased volatility, where you might get investors and traders start to actually treat the US dollar as a safe haven play, as is traditionally the case during highly volatile times.
Well, we shall see if it's going to be a hot, hot summer in terms of volatility. But Ron, thank you so much for coming into the studio today and sharing your perspective. It's been a pleasure.
Thank you very much.
Thank you. Well, that's all from Ron and myself for the moment. Click back to Dukascopy TV for today's press review and, of course, many more exclusive interviews. Goodbye for now.